If you're doing between $1 million and $10 million in annual revenue and you feel like you're working harder but keeping less, then there are 3 financial mistakes you're making right now that you probably don't even know about. I have reviewed more than 100 P&Ls in the last 12 months from businesses in this exact range, and I keep seeing these 3 mistakes over and over again. These aren't obvious things. Your accountant isn't flagging them. Your bookkeeper doesn't seize them, but they are quietly killing your ability to scale. So in this video, I'm going to show you what these 3 mistakes are, why they are so dangerous, and how to know if you're making them right now. So let's get started. First mistake, confusing profit with cash. So profit is not equal to cash. That's the mistake number 1. And this is the most common mistake. This mistake that catches almost every business owner I work with. Let me explain why. I recently came across a client which had $4.2 million in annual revenue. His P&L showed $750K in annual profit. So when the tax season came around, he assumed he had $750K sitting in the bank account to pay his tax bills, reinvest in the business, maybe take some money out. But when he looked at his actual bank account, the number was just $180K. So he was missing over $500,000 and he had no idea where it went. Here is where it went. $280K tied up in inventory that wasn't moving, $190K sitting in accounts receivable from customers who hadn't paid yet, $150K went to paying down a loan which obviously doesn't show on the P&L. So on paper, he was crushing it. 18% profit margins. Any CFO would look at it and say, looks good, you can scale. But in reality, he had a cash problem. And cash problems kills businesses more than profit problems. Here is what I need you to understand. Your P&L is a story, but your cash, your bank account is reality. Most business owners live in this story, that is their P&L account. They just look at their P&L account, they see the profit and think, I am good. But your bank account doesn't care what your P&L says. Your bank account cares about cash in and cash out. If you can't make payroll, it doesn't matter if you're profitable. If you can't buy inventory, it doesn't matter if you're profitable. The first mistake is thinking that these 2, that is profit and cash, are same, but they aren't. Here is how to know if you're making this exact same mistake. Pull up your P&L for the last year. Look at your net profit numbers. Let's say your net profit is $500K. Now go look at your bank account from January 1st to 31st December and ask yourself this question. Did your cash balance increase by $500K? And if the answer is no, and for most of you, it will be a no, you are making this exact same mistake. You are confusing accounting profit with actual cash, and that confusion is costing your business. Now, once you understand that profit doesn't equal to cash, the next question becomes, okay, so where is my cash going? And that brings us to mistake number 2. Not tracking cash conversion cycle. That's the mistake number 2. In simple words, you have no idea how long does it take to turn $1 of investment in your business into cash back in your bank account. This is called your cash conversion cycle. And if you're not tracking it, you're flying blind. Let me give you another example. Different client, $6.8 million in revenue, growing pretty fast, 35% year on year. Comes to me and says, we are growing like crazy, but I feel broker than I did when I was at $4 million in annual revenue. How is that even possible? I look at their financials and immediately see the problem. Their cash conversion cycle was getting longer. Here is what was happening. When they were at $4 million in revenue, they were turning cash in 45 days. They bought the inventory, sold it, collected the payment in 45 days total. But as they grew to $6.8 million, they started carrying more inventory, which took their inventory holding period from 30 days to 60 days. Second, they started offering better payment terms to bigger clients, which means their collection period became longer. So instead of collecting in 15 days, they started collecting in 45 days. And third, their suppliers got tighter. So they started paying their suppliers faster, which reduced their days payable. So now their cash conversion cycle went up to 95 days, more than double, which meant for every $1 they wanted to grow, they need to front up the cash for 95 days before seeing it back. They were growing, but they were growing broke. See, here is what most business owners don't understand. Growth requires cash upfront. You need to buy inventory before you sell it. You need to pay your team before your customer pays you. You need to invest in systems before they produce returns. The longer your cash conversion cycle is, the more cash you need to fund the growth. So you can be profitable as well as growing. But if your cash conversion cycle is getting longer, you are getting more cash strapped. Most owners don't even track this number. They just feel stressed and they don't know why. So this is the reason for that. So if you want to calculate what's your cash conversion cycle, here is the simple version of how to calculate this. Number one, find out how many days of inventory are you carrying. Add number two, how many days until customers pay you. Add these two numbers and subtract how many days do you get from suppliers before you have to pay them. Subtract this number and the answer you will get is your cash conversion cycle. If that number is growing as your business grows, that's the problem. That's why you feel broke despite growing. So now you know profit doesn't equal to cash, and growth actually makes your cash flow problem worse. But here is where it gets really dangerous, because mistake number 3 is the one that actually kills businesses. And that is funding growth with profit instead of working capital. You are trying to fund growth with your profit instead of understanding how much working capital you actually need. This is the mistake that bankrupts even the most profitable businesses. Let me show you how. Another client, $8.5 million in revenue, 20% net margin, so roughly $1.7 million in net profit annually. They wanted to grow to $12 million. So they came and asked, we have got plenty of profit to reinvest. We should be able to fund this growth ourselves, right? So I quickly ran the numbers. To grow from 8.5 to $12 million with their current cash conversion cycle and unit economics, they needed at least $950K in additional working capital. But remember, profit is not equal to cash. When we looked at their actual cash available after paying the taxes, owner's distribution and existing cash needs, they had maybe around $400K that they could deploy to fund this growth. Less than half of what they needed. They had two choices: slow down growth or get a line of credit to bridge this gap. But here is the scary part. If those numbers wouldn't have ran, they would have just tried to grow, run out of cash midway, and would have been forced to either lay off people or worse, close down their business. So most business owners think growth is funded by profit. It's not. Growth is funded by working capital. Profit is what's left after you have funded growth and keep the lights on. Confusing these two numbers is how you end up growing yourself into bankruptcy. You commit to growth you can't afford, and by the time you realize, it's too late. So here is the question you need to ask yourself right now. If you want to grow 30% next year, how much additional cash do you need to have in your bank account to fund that growth? If you don't know the answer to that question, you are making this exact same mistake. And if you are trying to grow without knowing that number, you are gambling with your business. Alright, let's bring home this point. The 3 financial mistakes every business between $1 million to $10 million makes. Mistake number 1, confusing profit with cash. Your P&L is a story, your bank account is reality. Mistake number 2, not tracking your cash conversion cycle. If you don't know how long does it take to turn $1 into $1, you can't plan for growth. Mistake number 3, trying to fund growth with profit instead of working capital. Growth isn't funded by profit, it's funded by cash upfront. These 3 mistakes are the silent killers. They don't show up in QuickBooks, your accountant isn't flagging them, but they are costing you big time. Now, if you're sitting here thinking, okay, I think I may be making one or all of these mistakes, but I don't know how to find them in my own numbers. That's exactly where I help business owners. I do financial clarity calls where we pull up your actual numbers, find these blind spots, and show you exactly what's going on and what needs to change. If you want that, the link is in the description. You can book a time that works for you. Otherwise, I'll see you in the next video. Peace.